Hi, I'm Shay Russell from ABC Bullion, and joining me today is none other than Jim Rickards. Jim, how are you today?
I'm fine, Shay. How are you?
Good, thank you. Now, look, you need a little introduction to the Bullion audience. You've been a guest of ABC Bullion in the past. You have appeared on the YouTube channel before. You are so you're a macro expert. You are a prolific author. I know that, there's plenty of books that you've written on the currencies, on gold, and also the new Great Depression, which we did talk about in our previous interview. But today we want to talk about gold and what the Fed is going to do next. Now, first and foremost, this is primarily a bullion audience. Let's talk about gold. And I'm going to start with one key question. Why should everybody own gold?
Well, there are a number of reasons, Shay, and you're as much of an expert as anyone, but it's the key factor is it's a diversifying asset. Let me explain what I mean by that. When you say, diversify your portfolio, everyone agrees there's a lot of economic science behind it. Of course, diversification is good, it's powerful. What diversification does, if it's done correctly, it should increase your total return without increasing your risk. Meaning, anybody can get a high return at a high risk. You can say, Jim, I want you to manage my money. I can go to a casino, bet it all on red. If I win, I come back and say, hey, Shay, look how much I made. But of course, if it comes up black, you lose everything. So that's a high risk, high reward, and in the long run, not winning proposition. But the question is, can you increase the return without increasing risk? Or can you increase the return more than the amount of risk? That's what diversification does for you. But here's the problem, Shay. Most people don't really understand diversification. I run into people all the time. They go, I'm highly diversified. I've got 50 different stocks in 10 different sectors, technology, consumer non-durables, services, mining, et cetera. I'm highly diversified. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which is stocks. And they become highly correlated in certain conditions. So yeah, you may have a lot of different stocks, fine. But if the stock market's going down, they all tend to go down together. If it's going up, they all tend to go up together. You're not really diversified if you're in a single asset class. Real diversification means having numerous asset classes that are not highly correlated to each other. So have a slice of stocks, absolutely, by all means. Have some government bonds. I like, for in the American investor, a lot of global investors, in fact, 10-year treasury notes. But Australian government bonds for the Australian investor, et cetera. Have some land, have some real estate, have some venture, have some so-called alternative assets, hedge funds. If you can get in, they can be hard to get into, et cetera. Venture and natural resources, oil, energy, water, and then some gold and some silver. So that's real diversification because gold will not correlate to stocks. Sometimes it does, but often they move in opposite directions. Gold doesn't. Gold correlates to bonds a little bit, but then you've got to throw in inflation, which helps gold and does not help bonds, and so forth. So what I just described. Oh, by the way, I forgot to mention a significant slug of cash, maybe as much as 30%. And I actually call it the barbell portfolio. So barbell, you got two heavy ends and a connector. So over here are your deflation hedges, and your deflation hedges would be bonds, utilities, and then you have your inflation hedges, and they might be, a normal stock portfolio, gold, et cetera. But cash is in the middle. Cash is the thing that connects the two. And cash has a couple of interesting properties. But people say, why would you have cash? It has no yield. Well, it has a very low yield. There's no question about that. But in a deflationary environment, which you cannot rule out, and I'm sure we'll talk about inflation in this interview, but you can't rule out deflation. In deflation, cash can be your best performing asset because the nominal value is pretty much unchanged, but the real value goes up because every dollar is worth more in a deflationary world. The other thing that cash does is the exact opposite of leverage. A lot of the assets I mentioned, I would include stocks, stocks, bonds, and hedge funds and others, and gold for that matter, they're volatile. They have some volatility. Cash has zero volatility. It's just cash. And so what it does is it reduces the volatility of the overall portfolio. So you can have volatile assets on either end of the barbell, but cash kind of damps that down a little bit. It helps you sleep at night. And then the third thing it does, and this is not very well appreciated, cash gives you optionality. It has embedded optionality. So we live in an uncertain world. That's kind of obvious. But how deep is the uncertainty? How long will the uncertainty go on? We don't really know. But so what that means is if you place your bets and say, okay, I really want to get into bonds, and I think there's a place for bonds. You get into bonds, and all of a sudden here comes the inflation. Those bonds are going to do very poorly. If you get into stocks and here comes a recession, the stocks are going to do poorly. So these bets can be good bets, but it can also be a mistake. Or you get into a private equity fund, can do very well, some have, but it's completely illiquid. Don't expect to get your money back early from Henry Kravis. He won't give it to you as you're locked up for 7 years. So the point is, the purpose of cash is, as we get more clarity, as some of these things, pardon me, Fed policy, central bank policy, inflation, deflation, the new COVID variant that's running around, this Omicron. As we get more clarity on these things, the person with cash has the optionality. You can pivot. If all of a sudden inflation comes in way higher than expected, you can go buy some gold. But if deflation appears, you can buy some bonds. So you preserve that. So think of cash as it's kind of an at-the-money call option on every asset class in the world. That sounds like a pretty valuable option. Well, that's what cash gives you. So a big slug of cash in the middle, maybe as much as 30%, just so that you can reduce volatility and be nimble. But real diversification is going to be stocks, bonds, alternatives, venture, hedge, natural resources, cash, gold. They're all going to be in the portfolio, and that will perform well in every state of the world. Some will do better than others, but that's the point. That's what diversification gives you.
Now, I just wanted to touch on something you said, so other people can actually go away and research about it if they wish to. Your barbell strategy that you just talked about then, fabulous strategy, by the way. You wrote about that in The Big Drop, one of your books, I believe, didn't you?
Correct.
Yeah, so I also think that book's a little bit hard to get these days. It's a collector's item, is that correct?
Well, that's correct. I have a great relationship with my publisher globally. It's Penguin Random House, and I've had six national bestsellers and hopefully more on the way. But the only book I wrote that was not with Penguin Random House, I got a waiver from them, is The Big Drop, published by Laissez-Faire Press in Baltimore. And it was never in bookstores. It was done as if you subscribe to one of our financial newsletters, you got a free copy of it. So it was never in bookstores. It was never on Amazon. So any copies that exist are sort of traded almost like underground goods. Now you can find it if you find it on Amazon. It's only because there's a secondary market. Some independent bookseller is posting it on Amazon or maybe Etsy, eBay. I don't know, but they're hard to get. There weren't that many of them in circulation. A bit of a collector's item, but a very interesting book. Every now and then I pick it up and go, we were a little bit ahead of our time there, talking about the use of the financial system to create a surveillance state, kind of thing that's going on in China right now with central bank digital currencies. There's a lot in that book, which was written, around 2015, if I'm not mistaken. So 6 years old, but a lot of it's just coming true today. So yeah, The Big Drop is sort of a fun thing if you can find it.
Yeah, look, I don't want to talk up a book that is almost impossible to get. I do have a copy of it, and I thoroughly enjoyed it. But the barbell strategy, I do believe through your financial newsletter, Strategic Intelligence, there's more information in there, so people can either find that in Australia through Fat Tail Media, or with is it published by Agora Financial in the US, Strategic Intelligence?
The Agora Financial owns their own press called Laissez-Faire Books or Laissez-Faire Publishing, but they're the publisher. But yeah, it is part of the Agora family. I make the point. The thing is, Shay, if you knew that we were going to have inflation, you would know exactly what to do. You'd buy gold, you'd keep away from bonds, etc. If you knew we were going to have deflation, you would also know exactly what to do. You'd buy a lot of 10-year treasury notes or Australian government notes, etc. But we don't know. I mean, I can argue both ways. As a lawyer, you always learn to argue everything both ways. But the point is, there are signs. There is a lot of data that would argue either way. And so, in an uncertain world, in a world where either inflation or deflation could arrive very quickly in greater measure than one expects, how do you prepare for that world? And that's where the barbell comes in.
All right, so we are going to touch on the uncertainty of inflation and deflation in a moment. But first and foremost, I want to do touch on about central banks buying gold. Now, this year we have seen an increase in the majority of Eastern European central banks, independent of the ECB, increasing their gold holdings. Now, I believe in your interview with Kerry Stevenson, who runs the gold conference, you mentioned that Japan has either increased their gold holdings or just announced that they own more gold than was first thought. What is this telling us? Are central banks moving into gold more rapidly than you've seen in the past, or is this a sign of things to come?
Both. They are accelerating their purchases, and I do think it's a sign of things to come. Now, when you talk about retail, so everyday investors, Americans, I love America, but I've kind of given up on Americans and gold. They just there are people who have positions, and your hedge funds will have paper gold, they'll do gold futures, but the everyday American has been 40 years at this point of being miseducated on the topic of gold. So they're not very much into gold. You go around the world, you get very different results. Switzerland, Germany, Austria, they love gold. Of course, China, Asian countries. I think Australians have a much better sense than Americans do. So there are the buyers of gold. But you say, well, okay, who are the big buyers of gold? The answer is the central banks. Now, right there, that should tell you something. So these are the most powerful, most plugged in, most heavily monetary institutions in the world. And they're the ones buying gold. Now, they would have you believe that gold's not money, gold serves no purpose. It's the first ones to say, John Maynard Keynes said it was a barbarous relic, which he never said, by the way. He said something, he used the phrase barbarous relic in reference to the gold exchange standard of the 1920s, which was a hybrid gold foreign currency standard, but the foreign currency is not gold. So he said that's a barbarous relic, but he never said that about gold himself. And actually, toward the end of his life, he favored, at Bretton Woods, he favored a global currency called the banknote, backed by gold. And it's not guesswork. There are papers he published at the time, and that was rejected by the United States, which kind of ran the show, partly because not to get too down in the weeds, but our Undersecretary of the Treasury, who was our representative at Bretton Woods, was a Stalinist agent. He was a communist. This didn't come out until the 90s, after the fall of the Soviet Union, when a lot of classified information was released, KGB files, etc. But it was revealed and fully documented in a book by Ben Style called Battle of Bretton Woods, that he was a communist agent. So what was he trying to do by insisting that, by running Keynes's idea off the road, insisting that the US dollar be the anchor? He was trying to destroy the British Empire, which he did, because he knew that there were far more claims on the Bank of England than they had gold, and that would be inherently unstable, and that would derail sterling as one of the global reserve currencies and undermine the British Empire, which it did. So that's a little bit of a backstory, but it goes to the point that Keynes was an advocate for gold at different times in his career and at the end of his career, and that when the central banks are buying, that should tell you something. Now, I've said for years, I've always pointed to Russia and China. Russia has almost quadrupled their gold reserves in the last 12 years, starting in 2009 through 2021. They've almost quadrupled, from about 600 tons to about 2,400 tons. China, the same, not quite, from about 600 tons to about just under 2,000 tons that they report, but they're non-transparent. They have a lot more gold than that stashed in something called SAFE, the State Administration on Foreign Exchange, which is a secretive Chinese sovereign wealth fund run by an ex-PIMCO guy, by the way. He knows what he's doing. And they're non-transparent. So the People's Bank of China is kind of transparent. SAFE is non-transparent. So every 6-7 years, what you'll see is the People's Bank of China will announce, oh, we've increased our gold reserves by 400 tons or 500 tons or whatever, as the case may be. And well, it sounded like they went out the night before and bought 600 tons. Good luck trying that. You can't do it. Well, what it means is that SAFE took some of the hidden gold that they had been acquiring slowly and in an accounting entry, moved it over to the People's Bank of China, and boom, there's 500 tons overnight. But of course, they had it all along, and they still do. So they probably have more. So Russia and China are big acquirers, again, tripling and quadrupling their gold reserves. But now we're seeing it in a lot of other countries. The Philippines, Vietnam, Mexico, Iran is a major buyer, but non-transparent. Turkey has drastically increased its gold reserves. These are major countries, and they're adding. So I look at that, and there's very good data from the IMF and the World Gold Council, so you can find this information. But the one that was just like not doing anything was Japan. They had about 600 tons. But they had 600 tons for 30 years. I went back and looked at all the old data. It was like 30, never, that was boring. Who cares about Japan? 600 tons. And then just about, at this point, about 6 months ago, so late last summer, they bumped it by, I believe it was 50 tons, perhaps more. I gotta look at the exact number, but it was over 50 tons overnight. It just went from, 600 tons to 650 tons, just like that. Well, here's what you know. Same thing I said about Russia. You can't buy 50 tons overnight, or you couldn't even do it in a month. I mean, the dealers would be working the order, it would be disruptive to the market. It would leave a lot of fingerprints, put it that way. But what it tells you is two things. Number one, Japan had the gold all along. They had it in some sidecar or side account or Ministry of Finance hidden account, as the case may be. And they chose to move it over to their reserve position, which they can do. That's an accounting entry, but they had to have had the gold all along, because you can't buy that much that fast. So then that begs the question, well, why all of a sudden? Why now, after decades of holding your gold level constant, you all of a sudden step up in a big way? A lot of possible answers to that. One, China's making noises about invading Taiwan. Well, if you're going to invade Taiwan, why not invade Japan while you're at it? It's just another chain of islands as far as the Chinese are concerned. And after this happened right around the time, maybe shortly after the U.S. debacle in Afghanistan, which was, the worst foreign policy, military disgrace, humiliation in U.S. history that I can remember. I don't know how far you'd have to go back to find a worse turn of events. And that there it was. Well, all of a sudden, allies all over the world, Israel, Japan, Taiwan, they're questioning the United States. Like, hey, we're under your nuclear umbrella. You stand by us through thick or thin. Here, you leave Americans behind enemy lines. So perhaps, now this is speculation, but perhaps Japan sees the threat to Taiwan, feels they may be in the sights of the Chinese, feels the United States may not be as reliable as one had thought, and says, well, we now have to step up a little bit financially, militarily, et cetera. And they're doing that. But that aside, that's a little geopolitical speculation, but that aside, the gold is real. They put it on the books. So the biggest buyers of gold in the world are the central banks. By the way, from 1970 to 2010, central banks were net sellers. Now, some bought and some sold, but on net, they were net sellers. We had Brown's bottom in 1999 when the UK sold half their gold at the lowest price in about 60 years. they literally hit the bottom at about $200 an ounce, give or take. But since 2010, central banks in the aggregate have been net buyers, and that buying is accelerating. So what does that tell you? It tells you that the most knowledgeable players in the world are adding gold to their reserves because they consider that a prudent hedge to the US dollar, if you have US dollar inflation, or to collapse of confidence in central bank currencies generally, or they're just saying, hey, we're part of the club. By the way, here's a good trivia question for you, Shay. If you're in a bar and with a lot of brainy economists around, ask them, bet them a drink on this. Ask them what percentage of U.S. reserves are in gold. The answer in China is about 2%. Russia is about 20%. You know what the percentage is for the United States?
It's got to be 0.5%.
75%. 75%. The U.S. does not rely on euros and Aussie dollars and Canadian dollars for its reserve position. A little bit, but 75% of U.S. reserves are in gold. So don't let any central banker, don't let Jay Powell or Johnny Yellen or any of these others tell you that gold's not a monetary asset. We have the largest gold stash in the world, and 75% of our reserves are in gold. So that's the U.S. As they say, watch what they do, not what they say.
Look, I know you made a comment before about risking getting into the weeds for things, but I'll be honest, Jim, that's why people love your interviews, because you do get into the weeds of things and you do give people the detail behind them. I did say I was going to get to the Fed after this question, but you said something interesting, so I'm going to follow that thread for a moment. You talked about how central banks were net sellers of gold from 1970 to 2010. Now, obviously, you know, in the past decade, we've reversed a 40-year trend. And this is pure speculation, but how long do we think central banks are going to continue to be net buyers of gold?
I would say indefinitely. I get everything, you know, changes in time, but when people talk about the price of gold, and I'll just use US dollars as a benchmark because it's a good global benchmark. It could be on Australian dollars or any currency. People say, well, gold went up, and then they say gold went down, you know, but gold really didn't do anything. Gold is an element. It's atomic number 79. It's a very nice, very attractive metal. What changed was the dollar price. That's what people mean when they say gold went up. They mean the dollar price went up. And if they say gold went down, they mean the dollar price went down. Well, but what does it really mean? Is that telling you something about gold, or is it telling you something about the currency? And I would say when the dollar price of gold goes down, that means the dollar got stronger. Each dollar buys you a little more gold. And when the dollar price of gold goes up, I would say the dollar got weaker because each dollar buys you a little less gold. When you translate it into weight, I always think about gold by weight. That's why I keep talking about tons and so forth, metric tons. So fluctuations in the dollar price of gold tell you more about dollars than they do about gold. It tells you about the strong dollar and the weak dollar. So as the dollar price of gold goes up, what it means is that the dollar is getting weaker. Now, so if you want to know the dollar price of gold, just do a long-term forecast on the currency, and you'll get to the dollar price of gold very quickly. So when you say, you know, is gold a good asset? Is it a good diversifier? Is the price going up in the long run? Great questions. And the way I think about it is, well, what's going to happen to the dollar in the long run, up or down? Well, what's the history of all central bank currencies? What's the history of all fiat currencies? What's the history of inflation? They all go down over time, not all at once. And that's another source of confusion because people look at, well, the dollar-euro cross rate, or they say euro to dollar cross rate, is the most heavily traded liquid, you know, foreign exchange cross rate in the world by far. So, and in the past, I would say 2 months, a little more, the euro has fallen from about $1.20 to today it's about $1.13. That's a significant decline in the value of the euro and a significant increase in the value of the dollar. So a lot of times when people say the dollar is stronger or weaker, they're actually not thinking about gold along the ways we just discussed. They're thinking about some dollar index. But if you peel back the layers of the onion for every index, Dow Jones, Bloomberg, Fed, it's all basically the euro-US dollar cross rate. So yeah, there's some Canadian, Australian, and yen and sterling. There's some other currencies in there, but the euro is the lion's share. So all these indices are really euro-dollar cross rates. So when people say the dollar is stronger, well, it's another way of saying the euro is weaker. But currencies tend to trade within a range. They'll get here or they'll go here, but they're not like stocks. You know, major currencies, they don't go to zero. I mean, Zimbabwe, yeah, but the Australian dollar or euro, they're not going to zero. But they don't go to the moon the way Apple stock or Amazon does. They can be strong or weaker, but they tend to trade within a range, which makes them interesting to trade because you can spot those inflection points. So right now, when people talk about the strong dollar, they're really referring to the dollar value of a euro. But you could have a situation where gold is going much higher in dollar values, and that would be, as they say, the weak dollar. And yet the euro could be falling faster than the dollar. So people always look at the euro and they say strong dollar, weak dollar compared to the euro. My only advice is look at the dollar price of gold. Use that as your thermometer. You know, doctor walks into a room, they see the patient, they don't know anything. What's the first thing they do? They take your temperature. So if you want to put a, you know, we don't use mercury thermometers anymore. They put a little X-ray thing on your head, but whatever it is. If you want to take the dollar's temperature, look at the dollar price of gold.
All right. Now, look, we could sit here and talk about gold all day, but I do want to move on to the Fed, because you threw out an idea one of your most recent Australian interviews that I think was a little bit controversial. Now, first and foremost, the Fed has been, the Federal Reserve Bank, just for clarification, has been talking about how inflation in the US is transitory, and they've been quite steadfast in that view. They've committed to ending tapering, that they finally put that commitment out in November, and now they have, I believe, as recently as last week, they dropped the word transitory about inflation from their language. So this is a significant step, because they have said all along that it is transitory and that it's nothing to get worried about. But you put out a controversial view that it's possibly not an inflationary environment that we are going to see in the US next year, that it might be deflation. Can you please explain how you're able to go against the grain and why you think this?
Well, first of all, Shay, just in terms of your overall comment, I did say that, and just to be clear, I'm really talking about disinflation rather than deflation. We could have deflation. That's when prices drop. But what I was, and so I'm not ruling that out, but what I was expecting is disinflation, meaning we'll still have some inflation, but it'll get lower. So it'll go from, I mean, I think the last monthly report year over year was about, well, it was well over 5%, but it was the highest in 30 years. So that's kind of very hot inflation. But I would see that trending down in the coming months to, 4%, 3%, kind of get back down to that, good old 1.6% where we were stuck for years during the period from 2009 to 2019. So you still have a little bit of inflation, but it's disinflation in the sense that the rate of inflation is lower than it was before. So inflation coming down, put it that way. And one of the best guys investing and financial analysis I've ever found is that the Fed, because they're always wrong, whatever they do, if you do the opposite or assume the opposite, you'll be it's a good starting place for your analysis. You got to do a little more work than that, but it's a good starting place. So I was about 4 or 5 months ago, I was very uncomfortable because my view is that the inflation we were seeing was temporary, transitory, if you want to use that word, that it would be coming down, we would get into disinflation. And I found myself in agreement with the Fed, and that made me really uncomfortable. They're always wrong. Maybe I'm wrong, but so I was happy the other day when they threw transitory overboard and said it got on the inflation bandwagon. I said, okay, well now I feel more relaxed because I'm disagreeing with them, and that's a good place to be. So yes, they did get rid of that. I think, let's bear in mind, we just went through Jay Powell's reappointment announcement, and he's going to have a Senate confirmation hearing, and there's a political aspect to this. And so he didn't want to be on the wrong side of that politically. Whether I'm not saying there was some behind the scenes deal with the White House, it's not impossible, but we don't have to assume that. I think it was just Jay Powell, the Washington politician, as much as the central banker, saying, okay, I'm getting beaten up over this, let's just take that off the table. The stronger inflation that we saw in March, April, May, June, and basically through most of the summer, a lot of that were what are called base effects, meaning, so how do we actually report inflation in the United States? Well, we do it on a monthly basis, but it's year over year annualized. So take the month of May or the month of June, the month of July, 2021, compare it to May, June, July, 2020, and take that year over year increase and then annualize it kind of, times 12 if you want, a little more to it than that. And that's your inflation rate. Well, what was going on in 2020? It's the lockdown, it was COVID. The US economy was flat on its back. So of course you had price decline. So when you get a year down the road to 2021, you would expect those prices to be higher, not because everything's out of control, but because the prior year was so weak. And if you're doing it year over year, which is how they do it, you're going to get some pretty hot numbers, and we did. So that was to be expected and not cause for concern. The real crunch came more recently in September, October, and now I think we'll be getting the November numbers in a matter of days. And the third quarter, 2020 third quarter, was one of the strongest quarters. We had a steep drop, and then we had the bounce back in the third quarter, one of the strongest quarters in U.S. economic history. So the base effect went away, and now you really are looking at something that's maybe a more legitimate comparison. And it was still a little hot. So then you're like, well, okay, is that COVID is that supply chain, because supply chain was not as big a factor. Maybe the supply chain was breaking down a year ago, but nobody was buying anything because nobody went outside. Now all of a sudden the shoppers are back and we're finding bare shelves again. You know, it's not just the paper goods aisle at Costco. It's one of our big box stores. It's everything, you know, and sad to say liquor stores don't have all your favorite wines. So we're seeing supply chain effects, and that would tend to make prices go up because we have a lot of money in the economy and shortage of supply. People are going to bid up prices, and then there's labor shortage, et cetera. So there are a number of factors in play, but then you still begs the question: is it transitory, notwithstanding those factors? Because you only get COVID once, so you only get supply chain breakdown once, then it just becomes the steady state, or is it is something going to change? Now that's a big debate. There are two sides to it. I still lean to the view that the disinflation is going to get the upper hand. And part of the reason I say that is real incomes are not going out that much. This new COVID variant that's going around, I don't have to tell Australians about lockdowns, but we have our own, and that's bound to slow the economy. The supply chain is bound to slow the economy. So if prices get too high in that world, you could actually tip into a recession. So, $4.50 is US dollars. I know everyone in the world thinks we have cheap prices, but a year ago, Americans were paying $2.25 a gallon for gas, and today we're paying over $4 a gallon for gas. Well, okay, fill up your tank, but that's less money for everything else, dining out, movies, clothes, whatever else you want to buy. So it hurts all those discretionary, consumer discretionary categories if more money is going into the gas tank. So you could have a setup for actual, certainly disinflation. I don't have to go so far as to say deflation, but disinflation, meaning inflation is transitory. And if it gets worse than that, you could even see a recession. Now, not right now, and I'm not making a hard and fast forecast, but you can see that trend. Now, I can take off my deflation hat, put on my inflation hat, and just look at the money supply, look at the government spending, look at the supply chain constraints and say, well, wait a second. If the government's spending, trillions upon trillions in deficit spending, which we are, and there are more bills, more legislation in the pipeline, which it'll get amended in some ways. It's not final yet, but it'll probably go through with another $2 trillion of spending. That much spending in an economy with declining labor force participation, supply chain bottlenecks, a new brand of COVID going around. What does that do to prices? Well, that might give you an inflationary boost. So the best answer is there are good arguments both ways. I don't want to sound wimpy about it, but I don't want to put a stake in the ground either. I lean to the transitory camp. I lean to the disinflationary camp. I think part of what Jay Powell's doing is for political consumption, but we'll just have to see. But again, it goes back to what we talked about at the beginning of the interview: the power of diversification. If you have that diversified portfolio, it doesn't mean that every asset class screams in every state of the world, but some of them will, and they should give you good total returns without too much risk.
Look, that is a fantastic answer. And I actually really like how, you swapped your hats between disinflation, thank you for the correction, and inflation. I might wrap up with my final question today on Jay Powell being confirmed again for the Fed. Does this mean we're going to see, further dovish policy coming out of Powell, or do you think he'll be able to navigate between the doves and the hawks that sit across the Fed board?
Well, he'll have to do some of that. And bear in mind, even with Powell renominated for his existing seat, and then I guess Lael Brainerd has been nominated for vice chairman. So she was already on the board of governors, but that's a promotion. Good for her. She's one of the big brains there. But they still have, I believe, 3 vacancies. So if Joe Biden wants a dovish Fed, he can have it because he just has to fill those seats. And it's generally and I've been in the board of governors room, and I've spoken to a number of governors and other insiders at the Fed, and have a little insight into the process. Generally, it's a really consensus-driven organization. And remember, one of the reasons Paul Volcker resigned in the 1980s was he almost lost a vote. I didn't actually lose it, but you don't want you don't want 7-4 votes, or you don't want 6-5 votes coming out of the Board of Governors. You want them to be, 11-0, or 9-2, or something like that. Always a couple of dissenters. But if Biden fills those vacancies with doves, and Powell's trying to take a hard line, and he has a couple of supporters, but not that many, he doesn't want to lose a vote. And so it begs the question: does he persuade others to come along with him, or does he join the Dove camp? And that remains to be seen. But what you don't want at the Fed are close votes. Again, 9-2 is fine, 11-0, fine, but you don't want 6-5. And if Biden puts in 3 doves as a concession to the fact that he did not make Lael Brainerd the chair, she's the super dove. I have a lot of respect for her as an economist, but she's definitely in the dovish camp. If Biden, and it's not really Biden, because honestly, he's not all there, it's the people behind him. But if they feel that they have to go with doves in the vacancy, and the Senate majority, a bare majority, confirms them, you could end up with a more dovish board. By the way, what Jay Powell's doing right now is hawkish. Because they laid out in November, they laid out the tapering plan. And it's always like watching a movie in reverse, Jay. So you watch the movie and then you play it backwards. So how does the Fed tighten? Well, first they cut rates, they cut, then they get to 0. Then when they're at 0, they don't want to go negative, so they're not going to go negative. So then they start QE, so they start buying bonds with printed money, filling out the banks with money, and then they get these huge excess reserve positions and all this quantitative easing, et cetera. When they decide to tighten, they play that in reverse. So they don't raise rates. What they do is they reduce the money supply, they reduce base money, quantitative tightening instead of quantitative easing. And then when they get to the point where they are not buying any net government securities, they'll still do the rollovers, of course, but they're not adding to the money supply, they're not adding to their portfolio of government securities. Then and only then will they begin to actually raise rates, the famous liftoff. So they laid out a plan. They said, we're going to start tapering in November, which the 21, which they did, will be finished by, I think it was June, sometime middle next summer, at a 20 billion per month tempo for 6 or 8 months, however many months, and that would reduce the purchases to 0 by the time they got to next summer. And then they would look around a little bit and they would lift off. And then does that mean 2 rate increases in the second half of 2022? Maybe, one 2022, one early 2023, maybe. It remains to be seen. But that's just the whole thing in reverse. So first, instead of buying securities, stop buying securities, bring your purchases to 0, pause, and then raise rates. So you're watching the thing in reverse. Now, what Powell said the other day is that we may taper a little bit faster. We may pick up that tempo. And he didn't say this in so many words, but a logical inference would be, well, okay, if you're going to accelerate the taper, that means you're going to accelerate the liftoff, because you'll be done with the taper and you're going to raise rates sooner, and the odds of 2, maybe 3 rate increases in late 2022 went up. So that's what Powell has laid out a tightening program. Now I'm looking at a few things. Number one, the Fed is always wrong, so that's my default position. Number two, a lot of reasons to be concerned about the U.S. economy right now. We'll know more in a few days based on some new data that's coming out. But if things are really slowing down because of the supply chain, if things are really slowing down because of the new COVID variant and new lockdowns and travel restrictions, and this is going on all over the world. It's not just the U.S., but the U.S. is certainly affected by it. And those are all headwinds to U.S. economic growth. Do you really want to be tightening? Probably not. Mm-hmm. So one of several things is going to happen. Either they're going to blunder into a situation where they're tightening into weakness, which, by the way, is exactly what they did in 2014. Because you go back to, when was the last taper? Well, they announced it in 2013. It was a big uproar, but they started it in late 2013. They finished the taper in late 2014. They then promised us the liftoff, which they didn't get around to until December 2015. It took a whole year to get to the liftoff, and then they raised rates over the course of 2016, 2017. Well, what happened? The fourth quarter of 2018, the stock market fell 20% in 3 months, from October 1st to December 24th, what I call the Christmas Eve massacre, 2019, I believe. It was 2019, sorry. But the stock market fell 20% in 3 months. In other words, they did exactly what I see them doing again. They tightened into weakness. And then what did Jay Powell do between Christmas and New Year's that year? He said, we got to think about this. And then what did they do next? They cut rates. And what they do next? They started, when they got to zero, they started quantitative easing again. So they went through a whole easing cycle. And then they went through a whole tightening cycle. And that screwed up, almost sank the economy. And then they went to easing again. Now they want to start a tightening cycle. Wrong policy at the wrong time. They may spook the stock market. They may put the U.S. economy in a recession. They'll probably have to backtrack. So just to summarize all of that, Jay Powell's in charge. He is tightening. It remains to be seen if these vacancies, if they get filled anytime soon. They may not. Tilt him a little more in a dovish direction. But for right now, he's not. He just said he's going to accelerate the taper. That's probably the wrong medicine at the wrong time. And that's part of why I see disinflation, not inflation.
Look, Jim, that is an incredible place to leave our conversation. Now, just for anybody watching, you've got some fabulous books out that actually cover a lot of what we've talked about today, but in more detail. Obviously, it goes without saying, The New Case for Gold. I'd be crazy to not mention that one. Then we've got The New Great Depression, which is your most recent one. And that's sort of a precursor of what's ahead. That's really directing people to what is yet to come, which I think is fascinating. And also to your book, Currency Wars. I know this was written quite some time ago. There's still a lot of relevance in that book, and I definitely think investors should check that one out as well.
Thank you. It's the book's I'll be 10 years old this month, and it's still selling very well, happy to say, and a little bit of a classic. But yeah, that's there's stuff in there about Ukraine. It's still in the headlines today.
Yeah, no, it was a fantastic book. And obviously, like your children, I won't ask you which one was your favorite. But I just want to say from everybody here at ABC Bullion, I want to wish you and your family a very Merry Christmas and a Happy New Year.
Thank you, Shay. Same to you and all the viewers. Merry Christmas.
Merry Christmas, and I'll see you next year.